Hey, what's good, YouTube? It's your boy Will coming back. As I told you guys Friday, I would probably be making an options video now that I did order a new tool that I can use to kind of break down how to better explain options to you, especially over a YouTube video. Because again, there are a lot of things you need to take into consideration when buying options, but it is a good strategy, especially for those of you who are starting off and investing with smaller amounts of money or essentially anything under $1,000. This gives you a better way to take advantage of the money you have over a long period of time, and I'll explain why in the video. So we'll get right into it. This is an options chain. As you can see, I usually quote this for AMC. However, there are way more companies out there than just AMC. AMC is just one I focus on because of the potential that it has, being that it is a short squeeze play, right? But I mean, we can look at multitude: Newegg, Astra, DD, FTFT, or Future FinTech as it's known. This is a Bitcoin play or a cryptocurrency play. You got Clove, you got Fuel Cell, HIMS, Microvast, Wish, Sensonics, QSI. This is another company I'm actually heavily invested in, and I'll talk more about it later in another video and how I found it and what strategy to use to find companies. Because again, there are way more companies out there than just AMC. But what I'm trying to signify to you is that a lot of companies actually have options out there, not just the ones I quote in AMC. But essentially, what an option is, or what an option contract is, and we'll go straight into the specific definition of it, right? Options are contracts that give option buyers the right to buy or sell a security at a predetermined price on or before a specific date. The price of an option, called the premium, is composed of a number of variables. Options traders need to be aware of these variables so they can make an informed decision about when to trade an option. So that's what we're going to talk about today, are the variables associated with an option, right? So I'll put the definitions of what it actually means in the description of the video. If you want to look at it today, you can, or a later date. You might have to watch this video a couple times to understand exactly what I'm talking about. But essentially, we're going to talk about specifically the Greeks, and we're going to talk about two specific Greeks in general: delta and theta. Okay? And I actually have some screenshots that we can use to better help understand, and you'll see exactly why I'm saying this strategy works for anyone who's starting off with lesser amounts of money. Okay? So let's say you start off with 500 bucks, right? This is how you're going to start off your account investing. So if you were to buy, let's just say AMC at $34.41, you could afford to buy 14 shares. Okay? If the price of AMC goes up $10, right? So it goes up $10, you would make essentially $140. Well, there are other ways to make money than just this simple breakdown, right? One of the ways is options. Option is a tool you can use to make significant amounts more money. So I took some screenshots of some of the screens so I can break this down. So this is an options chain. When I'm showing you this and I'm showing out the calls specifically, I'm basically telling you how many people think this company will go up. Whether this says AMC, Apple, QSI, FTFT, SNES, it doesn't matter. The point of showing you this screen is that when this number here is higher than this number here, more people think it's going to go up versus people thinking it's going to go down. Because you buy a call when you feel the stock will go up. You buy a put when you think a stock will go down. Okay, so that's this. On this screen, you will also see dates. Okay, when you buy an option, you're buying a contract. You're not actually buying shares. So you're buying a contract that gives you the right to control shares. The difference is I can buy shares and hold them for eternity. When you buy an options contract, it's based on a time frame, whether it's August 20th, August 27th, or you can go even out further, like January 21st, 2022, or you can even go January 2023. You're buying that contract on a time frame, so it has an amount of time designated for that specific contract. So let's get into specifically the contracts themselves. So I took another screenshot of an options chain. Okay, so these are the Greeks. Okay, so the ones that matter to us in this video today are delta and theta. Okay, delta is the amount of money you make per dollar a stock goes up. Again, as I already stated, you're going to probably have to watch this video multiple times to fully understand what I'm explaining in general. Delta is where we make money. This amount of money here are how much we make every time a stock goes up $1. And I'll do the math for you here in a second. Theta is the amount of money you lose per day that you hold this contract. Because again, it's a contract with a time frame. So you have to lose something every day that you hold it. What do the contracts cost? Well, here as we can see, the expiration date on these specific contracts here are January 2022. The strike is referred to as what we think the price will go to. So whenever you would buy an option is in a scenario like I described. You have $500, you want to invest in a company, you don't want to or necessarily have the time to be looking at it day in and day out all damn day. So you're essentially a long-term investor. So you're in it for the long haul, right? And you can't afford to buy 1,000 shares off of one hit because you're again only starting with $500. So you have to utilize your money in other ways. One of those ways is by buying option contracts. Let's say you are bullish on AMC and you feel you're right. William is right. It is going to squeeze all the other YouTubers that have been talking about it. Everybody on Reddit and YouTube and everyone else are right as well. I have a feeling it will squeeze. I want to make my $500 be as impactful as possible. Well, in this option chain, you would be able to take essentially control of up to at least 100 shares or even more if you spread your money out thinner. For example, if you were a buyer of a contract at $500, you would be somewhere in the vicinity from here down, essentially, because these it says $5.05. Again, remember, it's 100 shares. So every number on this chart is essentially multiplied by 100. So this is not 505 or $5.05. It's $505 you would pay for this contract, where you are essentially making $37 for every $1 this company goes up. Now this again applies to all companies, not just AMC. I'm using AMC because that's the one I talk about the most. But essentially this contract here pays $37 for every $1 AMC goes up. You essentially lose 4 cents a day or $4 a day of the 505 you paid for it. So if tomorrow it doesn't go up, Monday it doesn't go up, it stays neutral, right? This contract goes from being what you paid 505, you lost $4. So now you're only at 501. So if you sold it Tuesday, you would only get $501. That's as easy as I can explain Theta. Theta is how much money you lose per day. Delta is where we're interested because this is the amount of money we're making, right? So essentially, you're only starting with 500. You could easily buy this one contract. So the bid is what people are paying for them. The ask is what people are asking for them because someone holds these shares that's selling you this contract. For example, I have 2,200 shares. I could easily sell out 22 separate contracts myself at $2,200 a piece, and you guys or whoever buys them would essentially pay me $505 for that contract if they wanted to pick up my shares, for example, or if I wanted to sell my shares on a contract, right? There's always got to be a buyer and a seller, and there are thousands of people who are buying, thousands of people who are selling. That's how the stock market works. No one company goes straight up, no one company goes straight down. So with that in mind, specifically, there are two strategies you can implement with those $500. You could easily pick up one of these contracts. You could bid, for example, this one and say, all right, well, I want to pay 500 flat. And you put it in the request, and if it's accepted, now you hold this contract where you're making $37 for every $1 AMC goes up. Or you could implement a double strategy where you're like, well, I want to try to buy or get as much bang for my buck. You could easily pick up two of these. Because again, $246, $246 and $246, that's $480 or $592 that you would pay. $492 for this contract specifically. Now you would hold 200 shares of AMC where you are making $20 for every $1 AMC goes up. So to kind of break down the math a little better, AMC goes up, let's say $5, right? If you have 14 shares at $5, what is that? 25. So that's, excuse me, it's a little bit long in the day. So you make $70 on these 14, right? So $70. I don't want to make mistakes. I don't want to get caught making a mistake, a mental mistake. So let's say with the delta that we saw earlier, at 0.37, you're making 37 for every dollar that goes up. So 5 times $37. This contract specifically would have paid you 185. As you can see, it becomes very, very profitable. How does it profit or benefit you in the long run? Well, we can do that too. Clear this out. We'll go back over here. There's actually a tool that you guys can utilize that I use frequently when I'm buying options. It's called an options calculator. So the strike date we were looking at for that specific one was January 2022, and we were looking right here at the $500 one. That's the one I want to use because that's where most of you guys say you want to start off when you start off investing, $500. So we'll go ahead and use this strike. This is saying we think AMC will go up to $65 by January 21st, 2022, and we're going to pay $500 for it. So in our options calculator, we can actually do that. I'll do this for you live. AMC, get the price, $34.41. We're going to select our option. We said January 21st, 2022, and we said the $65 strike, which is right here, 505. So we can just click the 505 to default. And now let's say, for prediction purposes, between now and January, we think that it could go from $65 or we could go all the way up to $265, just to give us a good range, so I can give you guys a good perspective. As you can see here, $70 up here to $260 essentially. So let's say September 18th, we'll just pick a nice closed out number. So we'll go with the 200. By September 18th, let's say AMC squeezes and it shoots up to $200. That one contract you spent $505 on. Again, it was us predicting AMC would hit at least 65 on a call option contract expiring January 2022. Again, with the cost here, we would basically net out, because we're a delta of 0.37, which again we can see right here, $37 for every $1 AMC goes up. We would be netting or closing out $13,554. This is not a joke. This tool I'll put also in the video description below so you guys can play with it and use it. I use this anytime I buy an option. Normally, I don't buy options that have anything below a 0.50, where I'm making $50 for every $1 a stock goes up. That's just me personally. You don't have to follow those guidelines. The one we talked about down here, which was 246, this one is paying you $20 for every dollar a stock goes up. This is, again, not just specific for AMC. It is for all stocks in general. I'm just trying to sum up the message in a really quick video, compact it out, because I know you guys don't necessarily want to watch a 20-minute video of me breaking down options, right? So you got to be effective, efficient with your time and with your message. So that, in a nutshell, is a call option and a strategy you can use, especially if you're starting off with a smaller amount of money to get into stocks. Again, I'll make more videos around options to better explain it now that you guys see my cool little tool that I actually ordered just so I can make these type of videos, because again, with options you have to do a lot of breakdowns. But I'll put the descriptions, the options calculator, and I'll get more into leaps maybe tomorrow on another video. A leap is just essentially a long-term equity option, right? So this is just a long-term option play, essentially a year or more out, as you can see, 12 months. That'll be the next video I talk about for leaps. And this again is for people who are starting off investing, who don't necessarily want to be checking a stock up every single day, but want to take advantage of some run-ups or potentially making some massive gains. As you see here, just to kind of in the video out with a bang, let's say Halloween, AMC hit 259. That's 18 racks or 19 racks you would make off of one option contract. As you see, it's very profitable, but always remember, with options, you're also risking this amount of money. Because with options, again, you're paying a premium for control of those shares, but you don't own the shares. So at the end of the day, you are essentially risking this amount of money that it could go bye-bye and you'll never see it again. But on the counter side, if you're right, and you're very right, it is extremely lucrative and profitable for your pocketbook. I mean, I don't know anything out there currently you can invest in that'll pay you essentially up to $19,000 if a stock goes up to $250. Just saying. Anyways, guys, I think you get the point of this video. Please leave excuse me. Please leave a like and a comment below, as engagement does help with the YouTube algorithm. If you have questions, leave them down below. I'll get to you. Don't forget, always look me up on Twitter and IG for other stock news and updates. Until then, I'll catch you guys in the next one.